there is clear evidence that, particularly with stablecoins and money market funds, you can extend a product that you have off-chain in a traditional sense and find new ways to access new users at different price points and in different product formats.
What we're seeing now is, if we look at market structure across the board, all the different participants are stepping in to say, how does this impact my business today? And what is the future vision or outlook of where I fit in this future ecosystem?
Today's episode is from the Real World Asset Summit, where capital markets and crypto leaders are converging to discuss the future of the tokenized asset industry. I sat down with Kaushal Sheth, head of US sales at Blockdaemon, Neil Chopra, head of strategy and business development at Fireblocks, and Jenn Senhaji, the head of growth and business development at Chronicle.
Even if a bank issues their own stablecoin, you want to be able to settle from bank A to bank B, even if they have their own individual stablecoins. And so I think there's just a lot of doors that stablecoins will end up opening.
We're going to have a good day. We're going to talk about infrastructure and institutions. I'm joined here today with Jenn, Neil, and Kaushal. And I would like to start off, maybe not everyone's familiar with each of your firms, but I think from an institutional standpoint, they probably want to know how you think about infrastructure from the perspective of like where the actual demand is today and what are you seeing internally at each of your firms. So start there.
Sure. My name is Jenn Senhaji. I work at Chronicle. We are a crypto native technology provider that services both DeFi and traditional companies, primarily in the area of price data. So what that means is we are an Oracle network at the foundation, and we allow blockchains to access price information and those applications on blockchains to access price information, crypto native price information. And then additionally, we allow off-chain assets like tokenized money market funds to come on chain in a way that's verifiable and fully transparent. So we've been around since 2017. We weren't known as Chronicle back then. We were actually just known as the in-house Oracle team within Maker, now known as Sky. So we've been at this for many years, looking at this problem space that exists for bringing data integrity on chain and making that scalable.
All right. Neil Chopra with Fireblocks. We are a digital asset infrastructure provider. So think of really the base layer of connecting into the blockchain, which is private keys and wallets, governance, and then an ecosystem sitting on top of that. If I look to the future in 5 to 10 years from now, I don't really want to care who's building what on top of our platform. Everyone at the end of the day who moves on chain needs secure access and interactions with the blockchain to run their business. We came out of stealth in 2018, very much focused on filling the gap of enterprise crypto trading operations. So we really proved out the scale and security of our platform and product. And I joined 4.5 years ago, primarily focused on the TradFi space. And so I think it's been really interesting over that time to see how, I'll say, the blockchain and crypto native institutions have really started to build and grow. And we can see that from everyone here in this room, as well as some of the more traditional institutions who are taking the first steps in and really starting to bridge the gap between what we have today with traditional market structure, technology, and infrastructure, and then ultimately what this, I'll say, new paradigm looks like over the next 10 years.
Hey everyone, I'm Kaushal Sheth. I head up sales for Blockdaemon here in the US. Blockdaemon is a blockchain infrastructure company. I know there's a lot of infrastructure companies out there. We predominantly started as a node infrastructure company, so providing crypto native companies and financial institutions access to these blockchain protocols. From there, it was a natural transition to kind of evolve into staking, which is just another derivation of a type of node. And then from there, we started to think about like the full stack on what a financial institution would need. So that's MPC tech, wallet infrastructure, nodes and staking, and most recently DeFi. And so our goal is similar, to provide financial institutions that full suite of products to interact with blockchains.
I feel like I've been walking around this conference and there's like a lot of supply side, there's a lot of infrastructure out there. Some of it's fragmented, some of it is an all-in-one platform. But I guess, how do you kind of think about the fragmentation in the industry right now? And if you could kind of put it all into one place, is that really what these people want? Or are they coming to you for specific needs and different, I guess, like elements?
I guess I can go. Yeah, it is quite fragmented. There's a lot going on. Some people want, staking infrastructure. Some people want nodes. Some people want API access, wallets, and so it's L2s. So there's a lot happening out there. But I think the space is evolving in a positive way, where people are looking for that one-stop shop. It's really cumbersome to go out there and onboard 20 different providers, vendors, go through these rigorous due diligence processes. And so it's really important. Institutions are looking for, someone that has that unified single point of access to blockchain tech.
Yeah, I'll say I think fragmentation is sort of a necessary evil right now. We are, as an industry, trying to figure out where this plugs in and how it plugs in. Market structure is critical. The Clarity Act is going to be very important. We obviously had Genius pass recently as well, but regulations and regulatory clarity is just step one. There's now an interpretation of those regulations for what happens today. And I think that's the biggest hurdle. And so what we're seeing now is, if we look at market structure across the board, all the different participants are stepping in to say, how does this impact my business today? And what is the future vision or outlook of where I fit in this future ecosystem? And so really trying to find that starting point is critical to say, I need this technology in-house. I need to understand what it means and how I interact with it. How does it upstream, downstream impact my processes? And so as we start to see that for different asset classes, different market participants, everyone in this room, I think, is starting to come together to say, okay, well, what's the next evolution of this? But I think we need to be fragmented to start, because we're talking about regulated assets and securities. So they need to fall under some form of regulatory regime. We've seen it in Germany, Switzerland, Hong Kong, Brazil, where that market structure is being put in place, and it's really piggybacking off of how, say, crypto trading operates. And so it's already starting to disintermediate some of those participants. I don't think we're going to see that here. And so I think it's really now a question of who's going to do what, and what does this technology mean for all the different participants.
Is there ever a concern that when you're having conversations that they're just like too overwhelmed with too many options?
Yeah.
Because it's fragmented, they're like, we'll pass until it's all together.
Yeah, there's a lot of people that are saying that. I'll say over the last 4 years. Yeah, it's a big problem. But what I will say is that I think there's now been a shift. 3-4 years ago in the US specifically, everybody was saying, what do we do? Give me the Chinese menu of options and I'll figure it out. Now we're at a point where they're saying, we know we need to do something, and they're trying to figure out what the path of least resistance is, so that they don't have to allocate hundreds of people to a project or to a business line like a JP Morgan or a Citi, but they can start to just understand how this works. And I think that's the next wave. We've seen the first movers and the innovators. They are going to continue to progress. I think everyone else is sort of coming along for the journey. But there was an inflection point this year with the election and what we're seeing now. And I think it's just everyone trying to distill down where do I start. So it's a better conversation now because people know they need to do something, whereas the last few years it was more so like, hey, we can make money off of this. How can we make money? It's now a tech play. It's now a tech decision, not a crypto trading revenue type of model.
So do you guys feel like with the current compliance landscape, you brought up the regulatory side, which seems way more optimistic than what we had about a year ago, that these institutions are now actually comfortable to come in. They're not as concerned anymore. There's like these guidelines and I guess barriers are kind of cleared up.
Yeah, I think we kind of have to meet in the middle because the regulations are here. The interpretation of those regulations needs to happen at each of the institution levels. Mm-hmm. And so they need to translate them for what they want to do. So it's like, yeah, we have this clarity, but down here we need to say what's the starting point, and then how do we translate what's up here all the way down the stack.
And what do you think?
Yeah, I think, all of these factors are, a part of the consideration for whether it's an institution thinking about coming onto the on-chain economy, and looking at it from both a technical and a business use case perspective. And the infra, today compared to even 2 years ago, I think is much more accessible conceptually and like physically to understand, even if you're somebody that has never traded crypto or, thought about it. And you are somebody sitting in the compliance desk at JP Morgan or an institution, right? And I think really what is helping that comfort level is the fact that there is maturity with, the number of blockchains, the ability to permission certain blockchains. So there's privacy and KYC, KML features enabled where needed or where requested. And then even, thinking about from an Oracle and, value transfer perspective, there's a lot more rails in place to kind of check the boxes for those first questions that somebody, again, who might be contemplating tokenizing a product and bring it on chain. So those being, can I do my proper KYC checks? Is this going to provide constant uptime? Is there more than one choice? How quickly can I spin this up? So I think a lot of that has been solved and there's a lot of progress there. And then I think from the business use case side, there is clear evidence that particularly with stablecoins and money market funds, you can, extend a product that you have off chain in a traditional sense and find new ways to access new users at different price points and in different product formats. So I think that combination of the business and the technology argument is making everybody a little bit more comfortable and, opening their minds to learning even further.
This episode of Talking Tokens is brought to you by Fireblocks, the stablecoin infrastructure of choice for top global businesses from Visa and WorldPay to Bridge and Revolut. With over 100 billion in monthly stablecoin volume, Fireblocks powers stablecoin strategies at scale with infrastructure that enables PSPs, fintechs, remitters, and banks to issue, move, hold, and manage stablecoins. And it's all done securely at scale and with built-in compliance. With Fireblocks, you get complete control to build your own stablecoin orchestration layer, create payment accounts, manage liquidity, and access on and off ramps into over 60 currencies, making it easier to build, scale, and expand your stablecoin business globally. Learn more at fireblocks.com.
On the front of stablecoins, you brought that up. That's like literally what everyone wants to talk about all the time. So we're going to talk about it. I do see that as like a very big bridge between the TradFi world, DeFi world. I think a lot of institutions that I've spoken with, and you guys probably have as well, actually understand the value of stablecoins, right? Whereas maybe a year ago, they didn't really care for it as much because the regulatory environment wasn't there. But now that we have Genius Act passed, things have changed a bit. So when it comes to kind of implementing stablecoins and really bridging the gap between that side of the spectrum and our side of the spectrum, how do you guys think about integrating it in a way that is, significant to these institutions?
From what we've seen I'll use the money market fund example first, because I think everyone knows how we do DVP and atomic swaps for crypto trading. That clearly makes sense. What we're seeing from money market funds now is this usage of collateral. And so you have these collateral management tools now that you can embed digital or tokenized versions of collateral within. I think money market funds are a great option there. I do also think that stablecoins will prove to be a great option for traditional markets before we bring tokenized assets on chain. And the reason being is that you now have more control and really 24/7 in the ability to now post and manage collateral back and forth. And I think it's really going to need to be some of the legacy or traditional FMIs and CSDs who offer up that opportunity, because all we're seeing now are an increasing number of institutions moving on chain and trying to manage treasury on chain. And so I don't want to have to go trade crypto derivatives here, use stablecoins and tokenized money market funds, and then come off chain and trade equities through NASDAQ or CME derivatives, and I can't post a stablecoin as an example. So I think there's a bridge that needs to happen first, which is going to be stablecoins used in traditional trading flows, because that then proves the model and it proves that there's a utility there, and then we can start to layer on the other asset classes and have more DVP type functions.
What do you think?
Yeah, I mean, I agree with what Neil said. I think stablecoins are just phenomenal. Like from a tech perspective, they're opening up new doors. Interoperability is going to be like a key factor, but like liquidity as well, right? Even if a bank issues their own stablecoin, you want to be able to settle from bank A to bank B, even if they have their own individual stablecoins. And so I think there's just a lot of doors that stablecoins will end up opening.
There are other ways that you see stablecoins kind of accelerating growth for on-chain assets?
I think Onchain FX is going to be really interesting. I think there's a lot of hurdles for securities and DeFi. I think there's a more efficient and structured approach for Onchain FX. And I think everything that we've seen, at least at Fireblocks for 8 years, is the blockchain and crypto natives are kind of proving out different models, and then they're getting repurposed by TradFi. And so I think DeFi has been proven. We now have to figure out how DeFi translates into traditional markets. I think the lowest hanging fruit is FX because there's not as many regulatory constraints around fiat and stable coins. And we have AUM, like we have value and velocity moving in stable coins. It makes sense. There's money to be made because everybody's basically having to rely on the major correspondent banks. Everyone else says there's a better way here, and there is. So we just need to prove the model. Once the model is proven, then we can scale it. Oversimplifying proving the model, because obviously that's going to take
we don't have enough time.
ton of time. But yeah, if anyone wants to chat afterwards, happy to build out an on-chain FX model with you.
What are the other opportunities you see at Chronicle then, Jenn, with stablecoins in mind?
So stable coins, I would say those are, probably the easiest from like a data verification standpoint, right? Because they're usually backed by an actual dollar, like a fiat dollar or a T-bill or something that's fairly stable, or, there isn't a liquidity issue with them, and understanding like, is the profile of this asset going to change because there's not enough liquidity from what's backing it. So from, a data integrity standpoint, stablecoins are just the easiest, to kind of relay information on. And I think just also from like a consumer standpoint, it's also conceptually very easy for people to understand and transact with. And to your point, like FX and all these other more kind of like, traditional ways of moving money cross borders is improved by just the ease of this 24/7 real-time stable asset.
Mm-hmm. Stablecoins aside, where else are you seeing demand right now? What are people asking for all the time?
I think tokenized collateral, like mobility, we touched on that a little bit, but I think like, if you're in Japan and you need to settle a trade and, London trading hours are not quite open yet. So like, you could have settlement take place just on these like rails that we're building, having the right tooling, right? People don't think about that all the time, but just, how are you moving these assets? Where are they being stored? How are they being stored? How are they being recorded on a blockchain? So all these things also play a factor.
Yeah, I would say a lot around sort of private markets right now. So Wisdom Tree launched a private credit fund, or I think it was earlier this week, on chain. We're seeing private equity now looking to step in as well. I think it all comes down to the ethos of blockchain has always been like basically democratizing finance. And so if you can now use these tools to enable more access to private markets and private assets, there's a shit ton of, can I say shit ton?
You can say what you want.
All right, shit ton of fintechs globally who are basically saying we have demand for US based and dollar denominated assets. I think the last 6 months has proven that everyone wants the dollar and everyone wants dollar assets. And so this is now just a new funnel and distribution model to get access to that. And it'll be a question of where is the demand and what is the demand. And I think we have to prove it with money market funds. We have to prove it with collateral, cash and cash equivalent investments. Because again, until you prove the model, no one's going to do it at scale. So you start with things that you can prove it with, and then you start to move up. I think equities are super interesting. But that's a massive lift. That's legacy infrastructure that's been in place for decades. We're not going to rip and replace that. Private markets, I think, are ripe for disruption. Everybody wants access, and there's no real structure in place or distribution model to do that at scale. This offers it. We just have to figure out how that's going to happen.
I don't think it's there yet, though, is it?
No, it's definitely not, and that's kind of what needs to get sorted. And again, like, the regulations will allow it. I think the administration will enable as much as they can. It's really up to the participants in the market, everyone in this room, to say, here's the role that we can play, here's the role that we want to play. And then it's really just connecting the dots to say, okay, well, here's the first issuer, here's the first distribution venue. Let's prove it out. Let's say, hey, we're getting more access, more AUM, driving more revenue. The fintech is saying we're getting new products out and launching to clients and making revenue off of trading spreads, et cetera. Then it's like, oh shit, okay, we can all do this now. But again, the model's got to get proven first.
Cursed twice.
Sorry,
3 times in a row.
Okay, not bad.
No. What do you guys think is the timeline then for these types of things that were previously inaccessible to the general public, general investor, for it to be accessible to them? And is the infrastructure actually there? You brought up the private credit markets. I also think of like these massive funds that were only available to accredited investors, if that. What is kind of the timeline for that?
I think it's here. Earlier, I think it was, last week, we saw like one of the first tokenized, I think Galaxy issued their equity. Right. It was tokenized by Superstate. I think that was fascinating. I can't recall anything like that ever happening. And that's accessible. I think Robinhood's doing a lot around tokenizing private equity. So it's there and it's accessible. And I think it's only going to continue growing.
I think we're potentially going to see also competition from other markets because, again, as living in the US, you don't get efficient or easy access and exposure to other geographies. And so I think other countries are starting to realize that. And to be honest, they're several years ahead of where we are. And I think they can start to sort of, again, build out these models that can be used as a baseline that we can translate.
Okay. Yeah, I think with tokenized assets in particular, the utility is kind of like coalescing around like more of the degen or like degen light community when you tokenize an asset, and then in that first step it is permission, and you have to be have the KYC and investor accreditation and be in a certain jurisdiction. But when you put a wrapper on it that could freely move about through the DeFi ecosystem, then that's where, anybody, you really can have access to a fractional part of that initial fund. And I think, that's kind of like that ground zero of where things will be built off of. And, looking at tokenizing equities, perhaps here in the US, there's enough places where everybody in the room and beyond could like call up their, brokerage account and say, I want to buy XYZ stock. In other places outside of the US market, that's not the case. And I think maybe, we don't, some of us may not appreciate that is a really cool ability that's being unlocked by tokenizing something like an equity and putting that on chain.
We talked about things that seem likely to happen or there's demand for that. What about on the flip side where there are things that you're like, we shouldn't be tokenizing this, or there's no purpose for that? Not to be negative, but.
Yeah, I mean, if you want to tokenize it, tokenize it. The question, I think, is like, what's the utility of that asset? I think we saw a bunch of like REIT and real estate tokenization projects over the past few years. Full transparency, I haven't like tracked where those go, but yes, it allows you to reduce minimum investment sizes, et cetera, and it's more efficiency within, I think, those operations. I haven't necessarily seen like what's the next phase of, okay, we have real estate on chain, what can I do with it now? I think that's the biggest question. The first question I ask when someone says, I want to tokenize X is why? And then what are you going to do with it? You can tokenize a private fund, but if you're just issuing it, putting it in a wallet that a custodian's going to hold for an investor until maturity, who cares? We need to focus on utility, and we need to focus on the incremental benefits that using this technology is going to enable. And I feel like there's a lot of experimentation, a lot of wheel spinning over the past 3, 4, 5 years. but we're getting smarter. And I think, again, we just bring all the participants along for the journey because there's value for someone somewhere. We just need to see if they're already active and doing something so we can connect those dots.
So don't tokenize everything.
Tokenize-
Or go ahead and
tokenize
find
what you
out.
want.
In the next 50 years, tokenize it all. Who cares? Like, we're all going to have wallets in
Taking up
our...
block space.
Yeah, we're going to have our Neuralink chips with wallets and signing capabilities. So, like, ultimately it will all be, but it's just going to be a step function, and we need to see what that path looks like.
Do you agree with that? See you inhaling.
Trial and error. Yeah. I mean, I think for right now, tokenize everything. Like there will be a lot of things don't succeed, but you'll find things that work and don't work. And it's a trial and error process. So, I mean, this is the time to do it, right?
Interesting. I feel like I hear opposite. Like everyone's saying, oh, tokenize everything. It's catchy. I like the way it sounds, but I don't actually think you should tokenize everything.
No, I'm not saying now we should tokenize everything. I think in 10, 20 years, most things will be tokenized because we'll be able to prove that value. I think we need to focus on asset classes, again, that are going to provide incremental utility and value by coming on chain. But then you extrapolate that across everything else. Like financial markets are going to get disrupted. CSDs and FMIs and custodians are going to get disrupted. I think that everyone can acknowledge that. We just don't know how fast it's going to happen. But the faster that we do this in this room and we actually prove the model, faster we'll all figure it out and then be able to, I don't want to say move on, but actually execute.
I think I would add, tokenizing everything. I mean, sure, I think that the kind of trial and error of finding out which assets have that actually have organic demand or has an ability to create demand is interesting to kind of discover through maybe the tokenize everything mindset. Yeah. But at the same time, that does require time, resources, teams to put those work streams together. So the actual practical, experience of that is not liked, right? And so I when you guys were saying tokenize everything, it reminded me of the different phases throughout crypto that I've been a part of since 2017, where it was everybody should have a DAO, everybody should have a blockchain, and it's absolutely not.
How did that turn out?
Yeah, we learned those lessons.
Everyone should have a stablecoin.
All right. Everybody should have a stablecoin. So maybe not everything should be tokenized. But I think, we're figuring out what sticks, what doesn't. So there is certainly value in having that open mindset.
Mm-hmm. How do you think DeFi can translate into TradFi in the long term? Do you see it kind of being hand in hand, replacing it? The argument is typically it's going to replace it, like you said, eat the future finance, all that stuff. But I could see a world where they coexist and move in synergy.
I think they have to, because at the end of the day, 90% of people out there are going to trust their institutions that they work with today. That's a generational mindset and shift that will need to occur. In 50 years, probably most things are going to be decentralized and banks are not going to be banks as we know them today. But at the end of the day, everyone relies on banks. They trust those institutions. They park their cash there. I don't know. My mom's not going to put a wallet on her phone and risk losing her phone. I've talked to her, trust me. It's like talking to a wall sometimes with this stuff. But that's ultimately what it comes down to, is the way we succeed in the medium term is the end user has no idea. And so institutions may be accessing DeFi to get access to more, better, faster, cheaper assets. But they're going to deliver those to the end users. I don't see end users accessing this at scale in the short term.
I mean, I think, yes, right now, and, our parents and even us on the stage would, feel it would be difficult to say everything could be converged, right? Digital, or rather DeFi and finance. We've definitely inched closer together. And I look forward to a day where, I don't have to bifurcate saying DeFi or TradFi or RWA. It's just finance. Yeah. That'd be nice. But I do think, kids, right? If you're under 10 years old and you're playing Roblox, right? You're used to these digital currencies from a gaming perspective. So I think just the mental model of like, everything I have is just a digital currency. There's things called stable coins. I don't care how it's operating underneath. I just know that I'm able to move money to, my cousin in, Colombia with a click of a button. I didn't have to call a bank. I didn't have to do anything. I think it'll just be kind of a part of the behavior and the expectation of the evolution of how people interact with money. But yeah, I think, it is on the horizon. I think, kids today, under 10, even probably 15 and under.
The kids get it.
They'll get it, yeah.
So why don't the
boomers
adults?
don't, but the kids get it, yeah.
They're still all idiots.
Yeah.
But yeah.
Yeah. I think like today it's further, obviously towards TradFi, but it is going to inch closer to DeFi over time, especially as like the UI gets cleaner, simplicity, like, you have so many different tooling today. And like, if you just abstract that all away and have one simple like middle layer for TradFi and DeFi, I think that simplifies it. But yeah, that younger generation, like that's where it'll kind of inch closer to DeFi permanently.
Yeah, amazing. Well, thank you guys for taking the time to talk, and thank you to everyone else for listening in.
Thank you.
Great job. All right. Good job.
That was great.